I used my role as mortgage broker to learn every piece of the puzzle.
Fast forward, I guess what was the next deal? Was
13 units, then 65, and then 116.
13 to 65.
Yeah.
I mean, it just compounds. Ron from Ronald, Rohde Law, and today we're sitting down with Barrett Linburg. He is a Dallas local, legend in the OZ Opportunity Zone space. But today's interview is going to be a little bit different, and we're going to talk about how you stumbled upon this kind of legislative gem and your background about what led you there. So Barrett, thanks for joining.
Yeah, thanks for having me. Glad my office is just down the street and I could join you here today.
Yeah.
So my career, I've been in real estate now for 20 years, and a lot of it has been just a series of good accidents. Kind of stumbled into different things because there was opportunity there, no pun intended, and found my way into different spaces, and have never really run with the crowd, but always looking for different ways to have an edge, and that's been a good way to get where we are today.
So let's back up a little bit. You graduated. You're a local guy from SMU, and what did you do? Did you want to do commercial real estate or?
No, I had no idea what I wanted to do when I graduated. I think during college, my mom dragged me to some charity event, and the woman next to me asked, well, what do you want to do when you graduate? And I said, I have no idea, but I want to be in the middle of an industry where there's a lot of money flying around and I can figure out how to have an edge. And she looked at me like I had two heads, but I think that pretty well summarizes like what I've done throughout my career, is that I've always figured out like where there's good things happening and that we can have an edge. So
do you say you put yourself in an industry or an opportunity to meet the right people?
Yeah. Yeah. So my first job coming out of college, I worked as an analyst for a commercial mortgage brokerage. And at that time in 2005 and 6 and 7, there was a lot of money flying around. So I worked in small balance commercial mortgage world, financing apartments. And it was pretty straightforward to help people with commercial real estate financing. There were several lenders, one large one out of Chicago, you were just pushing the loans and you could make good money doing those loans, and it was great. And It sounds
a lot like post 2020 with the kind of spigots being turned on.
Yeah, not dissimilar. And so, I was 22, 23, and I remember sitting with a mentor at that time saying, you don't understand, like everyone is making $300,000 a year. And he said, don't worry, it'll change.
It'll come back.
And I said, well, what do you mean? And I didn't understand what he was saying, but he knew.
Yeah, real estate is beautiful. I kind of came from that too. My parents were in real estate, more on residential and a little bit of commercial, but they were always clear that it's cyclical. And everything that goes up, must come down. But over the long run, it's going to probably trend up if you have population growth and good factors. But so after the mortgage, did that collapse in 08, 09 or?
Yeah.
Okay.
So I progressed at the mortgage brokerage to where I was kind of in a management role. I had 20-ish analysts working underneath me, which was weird at 25. And it was even stranger when the market collapsed and I had to start laying people off when I was 25. But what I learned is that, yes, the market is very cyclical. And also, if I want to stay in this business, and the same mentor kind of gave me this advice, like, you're young enough where you can go do whatever you want, but this business is cyclical. And if you want to stay in it, you're going to be one of the few that does. And you'll be in a very good position when the market comes back. And made a conscious decision to stay in the business. Made very little money over the next few years, but stayed in the business.
So you made that decision to kind of stick it out for the low run. Are you still doing deals and just fewer of them? Okay.
Yeah, I stayed in commercial mortgage brokerage at a time when no banks were lending and very few people could borrow. So there was very little commission to be made. But it was a time when you just built relationships. So you'd say to people, listen, there's very little chance of me being able to help you right now, but I'm willing to analyze your prospects, right? I can underwrite your deal. I can talk to banks about what might be possible. And so you're just building relationships.
How does that time period back then relate to the lending environment now? Because we're seeing parallels, but depending on your asset class, like I do a lot of industrial, banks are still opening up the checkbook for industrial deals.
Yeah, I think that's the big difference, right? In 08, 09, there was just no money to be had, period.
Yeah.
And that was weird. You'd have a not perfectly healthy, but you would have a healthy asset and no one would lend on it.
Even with a good sponsor, with a healthy balance sheet of the guarantors, right, with a strong fundamentals, and people were just so scared. That's my biggest criticism of lenders. I used to work, I was general counsel, and one of my mentors too, he's just, lenders are the worst. They're just follow the herd, and they all move together, and they never take a contrarian position because they don't want to get their head chopped off. But he said, as a business, it's terrible because you can just go and keep lending until the deals get bad, and then they all retract at a time when they should be putting out more money, when it's the lowest LTVs and safest, strongest personal recourse. But then the lenders don't, and they just ask, was somebody else lending? And if you bring them a term sheet, they'll, okay, we'll compete against another term sheet. But it kills me. So you were caught up in that, ocean current, so to speak.
Very much saw it firsthand. It was before I owned any property, so luckily I didn't have to go through that as an owner. But very much saw it firsthand and felt it as far as I had no income.
Right. So for people that own commercial real estate today, what would you advise them to do given the market cycle?
Well, I think, I don't know as far as lessons learned from back then, how they apply to today, but I think communicating with investors, but also bankers as well. If you have a maturity coming up, you want to be talking with your banker, because they have tools at their disposal, and they're going to be able to give you insight into what they're allowed to do, what tools they can do to help you or to hurt you. And you want to be listening to that.
Yeah, extensions or pure early refi or getting some certain, I've had it too where I do more small balance industrial, like the 5 to 10 million range. And if we can get a personal guarantor on a lease, which we normally don't necessarily need, sometimes that can be like, oh yeah, that'll move forward in my credit committee. And it's seemingly random things that don't have a connection to how we run our business, but if the lender keys on it and says, oh, we really like that piece, to qualify the lease. So it's weird. So I understand that. Talk to the banker and ask them, because they're not necessarily thinking the same way that operators and investors are.
Yeah, and I've heard from other guys in my position where they've had a relatively minor covenant breach in their loan, but their banker, their balance sheet is in real trouble. And so now their banker's calling them saying, hey, that you had a covenant breach, your loan is due. Whoa. And you realize this very minor covenant breach that 3 years ago would have been nothing is now a really big deal, because that bank has their regulators all over them. So it's very bank dependent, and you're not going to know that unless you're regularly talking with your banker.
Yeah, I think that's a great full circle piece of advice, because your banker is probably going to be your number one biggest investor, and a lot of people treat them as just this monolithic entity, but that's really not the case. They're a partner in dealing with them and how they choose to enforce certain things down the road. But yeah, luckily I feel like at least in Texas we haven't seen too much of the nitpicky defaults, technical defaults.
I think that one example has not been normal, which is great.
Well, and I think it could spread, though, where we could see it more is like if you were a borrower from Signature or First Republic, and I know those things happen very quickly, but there are definitely larger banks that have more office exposure, for example, on their balance sheet that are hurting, and they have a slow decline where it could be happening behind the scenes right now. And if you have a larger loan balance with them, that could trickle down eventually to the people on this, podcast listening. And yeah, they need to reach out and talk to their banker right now. And then when they find out that their banking relationship is left, that starts spinning the wheels too. Like, oh, geez, who's going to be servicing my loan? Do I need to? You've done the commercial mortgage side. You've gone through 08, 09. And tell us how you kind of transitioned into wanting to own stuff. Well, again, was that a conscious decision that I wanted to be an owner?
Yes, but there was an interim step. So in 2010, I decided to go to business school, but I did it part-time so that I could work at the same time. And I'm juggling 3 things. So marriage, business school, and now all of a sudden work's coming back again. Doing 3 things, and one of them always feels like you're failing at it. But for 2 years, you're learning to juggle all 3 of these things, and going, 100 hours a week to do it all. And that class, the SMU stuff was like 3 or 4 nights a week plus Saturdays. But then when you're done, which I finished in 2012, it was like, whoa, I have so much free time. And I'd made a little money over the past 2 years.
No kids yet?
No kids yet. And I don't know. There were some guys in the program who'd had kids like during or before, and I just, more power to them. But yeah, so all of a sudden you finish and you said, okay, well, I have new knowledge. I have a little bit of money, and I have tons of time. Because like this huge monkey off my back, I have so much time. And so I came home, talked to my wife, and said, like the market's gotten a little better, got a little money, got some time. Like, I think maybe we should buy an apartment. Like, I feel like we're ready and timing's right. Let's go buy something. And so we talked about it and underwrote some deals. And at this point, I'd been a mortgage broker for 7 years, so I'd seen people do it. And we found a little 8-unit building in the Oak Lawn area of Dallas, which is a good area for people who aren't in Dallas. And we went and bought it. My mother-in-law so we were half of the equity. My mother-in-law was the other half, and that was the start of kind of our apartment investing journey.
Must have a good relationship for her.
We do, yeah. She still lives across the street from us.
Oh, that's cool.
So
that's
yeah.
Cool. Yeah, so that was the first deal, and again, I think that journey parallels a lot of people in the commercial real estate stakeholder professional space. But what I really love is talking to people that are like me, same situation, commercial real estate lawyer. And I've been working and save up a little bit of money, and then you want to buy your first deal, because I've seen it so many times, and I'll say this for my clients, like, they're a bunch of idiots, but I see their net to seller on the settlement statements, and I help them buy it.
Right.
I help them buy it, and I get my little bit of fees. And then I help them manage it, sign some leases, yada, yada, and then they sell it. And I'm like, these guys are idiots. I'm at least as idiotic as them. I could do it too. And I think for anybody listening, you want to take your exposure to the piece, but have some humility about the other sides that you don't do. Because I'll say I was guilty of that, and maybe you were too, on operations. Oh yeah, just operate the property. What's really important is finding the deal and getting good debt, and capital stack certainly is really important, and real estate finance is critical. But you may tend to discount the pieces that you didn't touch intimately, and property management, just hire a property management company. So did you find that, or were you more prepared on the full 360 piece?
Well, I think a very good thing, and I don't know, this was probably conscious, but buying a very small property first, 8 units, and we did the construction management, and we did my wife did it,
okay.
Did the construction management and property management on our first project, was really important, because we learned it very intimately. Like, how do you get a unit vacant so you can renovate it? Then how do you lease it back up? Mm-hmm. How do you manage your subcontractors? Like, how do you do all this stuff? How does the accounting actually work? How do you submit a draw request? Like, all these things, we can do it now on our own. So now later when you're outsourcing it, you know exactly all the steps that go into it. So nobody can fool you later, which is really important, right?
Yeah, so doing it yourself the first time is critical. Paying for that experience, whether it's with your time or paying
making mistakes.
Making mistakes.
Yeah.
Okay, so you did that 8 unit. Do you still have that? Did you sell?
Nope, we sold it. A year and a day later, we closed.
Okay.
And it was great. We doubled our money. So that was really good.
Fantastic.
And I would say before that, though, like, having the 7 years of mortgage brokerage experience, I was pretty deliberate about going on site visits, getting up in everybody's business about what's your business plan here? Who are you going to hire? Why did you hire this subcontractor? How many vendors did you interview here? Just all those things. And I would do it under the guise as, look, I'm your mortgage broker. I have to tell all this stuff to all the potential lenders so I can get you the best terms. Tell me about your attorney. Let me see your operating agreement. I need to review all the title documents. Like, I used my role as mortgage broker to learn every piece of the puzzle. And I didn't even know that one day I was going to go buy buildings. I just knew that I wanted to learn all this stuff. And I think that was really important to prepare me to one day buy this little 8-unit deal and eventually go further.
Yeah, no, I think it's great that you look at that journey, and what's important to me is learning every step and then continually growing, because, fast forward, I guess, what was the next deal? Was
13 units, then 65, and then 116.
13 to 65, I mean, it just compounds, but you never set out, in one day in 2010 or 2012 when you graduated, like, I want to own 150 units.
No.
It's just an incremental growth and a focus on learning and I don't know, say for you, but like learning new things, learning one or two things on every deal, because you're curious and you want to know more and not just be a passive spectator on the sidelines. So we went from 8 to 13. And then, is that when we went into OZ stuff, or how did we find...
No. So this is still, I went from 8 units in 2012 to 13 in 2013 to 65 in 2014 to 116. And so it just kept building up, right? OZ didn't start until our first OZ deal was 2020.
So it was even pretty far after legislation, because that passed...
Yeah, OZ legislation was 2018.
2018, okay.
So yeah, we didn't get to Opportunity Zone until much later. I think we bought and sold 20-something deals before OZ ever entered the picture.
Wow. So is this capital now on the equity side? Is this all partners' equity? Are you doing raised funds?
Yes, all the above. So... first deal was my mother-in-law, was the additional equity. Second deal was my mother-in-law and my parents. Then the third deal was mother-in-law, parents, and a little bit broader circle. Fourth deal was all those people again, plus a few new folks. And it just snowballed from there, right? So when I explain it to people, it's like first deal was mother-in-law, second deal was a little bit bigger. Then it grew to friends and family. Then it grew to friends and family and their friends and family. And it's just kind of snowballed. And now it's the original group plus people I meet on the internet.
I mean, that's kind of a plug for Twitter and X. I mean, I know lots of operators who have fielded LP calls and, millions of dollars is being raised from X, from Twitter. It's crazy how... I mean, people feel like they really know you, or they like you, they like what you're saying, and then they're just, open to a phone call? Is that how they...
Yeah, generally, it's either a message through our website or through Twitter and saying, hey, I'd like to learn more about you. So we continued to raise 506B until last year. So the first call was, let me share more about Savoy. And then let me share some information about Savoy. Let me share our track record. Let's have one or two more calls. And then, hey, we'll include you. We'll send you information about our next project if and when, we have one. So we kind of continued doing that for a long time. But this year we've now switched to 506C. So we're actually, now my mom, when she wants to invest with us, has to prove she's accredited, which is a change for her. But I think it's the right way, given now I don't have to worry about, did I slip up and talk about a deal that we might be raising money for?
That makes sense. Yeah, I think that's a natural path, is just kind of this partners equity. Everybody's kind of an active, close investor. But again, I think it can be daunting of buying a commercial building, industrial, retail, whatever, by yourself. Even if you have the money to write a 7-figure, equity check, I think that people listening should say, diversify. Just reach out to somebody, because you had your wife, but that could have been a friend. That could have been somebody else in the industry that pairs your capital and has a different skill set as well as just availability. They're a second mind. So do you think that's useful for people trying to pivot or trying to buy something now is partners before going to a full syndication, or should they just go to a syndication and raise a good amount of money?
Well, what I know is that I wouldn't have the skill set today if I hadn't done the breadth of deals that we've done to this point. And I wouldn't have been able to do the deals that we've done to this point without other people joining us, as both as partners and as capital partners. So I think it's very important for me to have had these folks on the team with me. Because if I'd only done one or two deals, I wouldn't have the knowledge that I have today to apply to future projects. And then the other part of it is, I think that there are some projects, for example, in North Oak Cliff, we're doing kind of a neighborhood revitalization project. And it's turned into 20 buildings, which is about $50 million in equity that has been needed for all these
all
projects.
New construction?
It started with renovation, so it's like 14 renovation buildings and 7 new construction buildings.
And to caveat, when Barrett says renovation, he doesn't do renovation light. This is something that I know I think you're famous for, is you take a 50s era building and you gut it down to the studs to do everything right. And it's not just new flooring and paint and keeping the old structure. When you say renovation, you're doing serious work to the whole unit so that you walk in and you say, this looks like a brand new construction, because it is in a lot, any definition of the word. So these renovations are heavy renovations plus new construction.
Yeah, and maybe I skipped ahead in the story, but I think my point was the total equity for that is $50 million. And I hope that one day I have $50 million in cash sitting around to be able to do a project like that, but certainly didn't in 2020 and don't today. So we need other people's investment to be able to do projects like that. And I think that the return wouldn't have been the same or won't be the same without having to do that project at that scale. So for example, if we just did one building in that neighborhood, the return would suck. The returns are great because we're doing all of it.
I mean, I would probably even say that for a lot of commercial deals too, is that if you're looking at an 8 unit and you're making $500 a month per unit from residential, people say, oh, that's great, you're making $4,000 a month. And I say, no, that's not great. I would rather get an industrial, get a 10 or 12 cash on cash, and get appreciation and some cap rate compression. But the bigger deals, there's no such thing as like a small industrial. I mean, there is, but there's not like sub 2 million, sub 3 million that are, I think, really, really good. But you get a higher cash on cash. You get more money to pay vendors to do things. But your project is almost more of a neighborhood lift though too. So how much of that is, do you think it's the size versus improving a whole area or community?
Well, I think that's where I was going, is that you couldn't have improved the whole area without having done that many.
Oh, I see. Okay.
Yeah.
Okay. Yeah, I mean, I think, again, that neighborhood is great proximity. You're so close to Dallas. You're close to all that stuff. Bishop Arts, obviously, is a big draw. But that hasn't become a goal. That wasn't a goal for you. That just kind of grew by growing. So let's talk a little bit about OZ.
Sure.
Maybe do a 30-second primer for people who don't know what it is and kind of how you guys use it in your pitch.
Yeah, so the progression to OZ was interesting. So as the market continued to get hotter, we learned new tricks, just like we learned our way into doing our first project. We kept learning new things along the way. So we learned historic tax credit. We learned fractured condo deconversion. We kept doing these huge gut renovations along the way. And then eventually, and we were doing projects in East Dallas, in Oak Lawn, and in Oak Cliff already. And so our attorney said to us in 2019, you guys really need to learn this opportunity zone stuff. And I learned enough about it, but still didn't know much. And then in 2020, this portfolio of 8 buildings in North Oak Cliff came up for sale in a really rough neighborhood. I mean, it was tough, and they were really rough assets. And they were in an opportunity zone. So I called our attorney. I've worked with the same transactional attorney since 2014. And he knows OZ, knew OZ, knows OZ well. And I said, all right, you need to teach me OZ. Let's figure it out. And so we raised opportunity zone funds. People who had capital gains helped us buy those first 8 projects in North Oak Cliff, a neighborhood we now call Bishop Ridge. So the benefit for our investors is they had all had capital gains prior to investing with us. So the first benefit for them is that they do not owe taxes on those capital gains until April of 2027. So they get a deferral on their tax payment.
And that's the 10-year?
Nope.
No, that's the tax-free.
They just get a short deferral on their tax payment. So that's the first thing.
Okay.
The first small benefit of opportunity zone investing, but it's the smallest benefit. The much larger benefit is, hey, we used that money to buy these 8 apartment buildings. And then we renovated them significantly. And it turns out we made the neighborhood better. So now we're going to own those 8 buildings for 10 years. And they're going to be a lot more, they already are more valuable. When we sell them, all of the appreciation that happened over the 10-year hold and all of the depreciation losses that we pass through to our investors are not taxable. So for example, if I'm going to use pretend numbers, but say that it was a $10 million investment of equity and the cost of those assets was $30 million. So 20 million of debt, 10 million of equity, we spent 30 million. And in 10 years, we sell them for 60 million. Well, now that 10 million turned into 40, and it's a $30 million capital gain. There's no tax due on that sale, that's nice.
Yeah, it's pretty tremendous. And I know that you and I kind of talked about it too, because I actually have an industrial property in an OZ.
Yep.
And that's kind of our thought process too, is just, let's just hold it. I think, certain OZ tracts really benefited from that legislation. And, if they're in great neighborhoods or adjacent, I don't know. I mean, I didn't know why you needed OZ per se on that census tract in Plano, Texas, with a median income of like $87,000. But okay, so that's interesting. So people can place it with a 10-year mindset of all of those gains. And again, I feel like I like it because if you make that conscious decision as an investor or as a either LP or a GP to buy in the OZ, you're going to get kind of more, not mandatory, but you're going to get a greater incentive to be more illiquid, which I think investing in real estate, right? The liquidity is a feature, not a bug. I don't want to have to panic sell. I don't want the ability to panic sell. And that lack of liquidity is what really keeps you going for the long course. So OZ is kind of a enhancement of that illiquidity as, hey, let's just hold this because now we're not going to be one of these 1031 buyers looking to buy, a mattress firm and a Dairy Queen, cap rate.
Yeah, and the key is it's illiquid in the sense that you can't sell for 10 or more years, but you are allowed to refinance. You are allowed to distribute rental income. So these folks that invested with us in North Oak Cliff, and we've now renovated the properties, stabilized them, we can now go refinance, distribute the refinance proceeds, and distribute the rental income.
Yeah.
So hopefully, prior to year 10, we've sent them back more than $10 million, which would be a huge win for everyone involved.
Yeah, I think refinancing is one of the secrets, and I'll make this as short as, refinanced proceeds are not taxable. It's not a taxable event. And there are lots and lots of situations, I think more so in commercial, that you can refinance out 100% of your equity when even a very conservative cap rate or a lender is okay to give you 100% out, because if they're only at a global, 60%, 55